Join me as I dive into the top investing errors that could be costing you money and see if I can spot them all before making my next investment. When it comes to investing, it's crucial to avoid costly mistakes that can drain your wealth. The truth is, even experienced investors make errors that can lead to significant losses. But by being aware of these common pitfalls, you can protect your hard-earned money and achieve long-term financial success. Emotional trading is a typical mistake many investors make. It's easy to get caught up in the hype of a hot stock or to panic when the market takes a dip. But making impulsive decisions based on emotions can lead to poor investment choices. Lack of research is another common error. Many investors fail to do their due diligence, leading to investments in companies that may not be as stable as they seem. It's not uncommon to see investors putting all their eggs in one basket, failing to diversify their portfolios. This lack of diversity leaves them vulnerable to market fluctuations, making them more susceptible to losses. Furthermore, having an unclear investment goal can also lead to unsatisfactory returns. Without a clear strategy, investors may end up chasing short-term gains, neglecting long-term growth. Investors often fall prey to herd mentality, following the crowd without questioning the validity of the investment. This can lead to a vicious cycle of investing in overhyped assets, only to see their value plummet. And let's not forget about overconfidence. Investors who overestimate their knowledge or abilities tend to take on excessive risk, which can result in devastating losses. Let's take a closer look at these investing errors and how they can impact your investment outcomes. Emotional trading, for instance, can lead to a roller coaster of buying and selling, resulting in significant transaction fees. Lack of research can cause you to invest in companies with weak financials, putting your money at risk. Diversification is key to spreading risk, but without it, a single market downturn can wipe out your entire portfolio. And when it comes to unclear investment goals, it's like driving without a map. You may end up lost and unsatisfied with your returns. Herd mentality can lead to investing in assets that are not aligned with your goals, causing you to miss out on better opportunities. Overconfidence can result in reckless decision-making, leading to catastrophic losses. But there's one mistake that stands out from the rest: the failure to have a well-thought-out exit strategy. Many investors are so focused on getting into an investment that they neglect to plan their exit. This can lead to being stuck in a bad investment, watching your money dwindle away. So, how can you recognize this critical mistake? Start by setting clear goals for each investment, including the desired return and time frame. Make sure you have a plan in place for when to sell, whether it's based on market conditions or a specific event. And most importantly, stay disciplined and avoid making impulsive decisions based on emotions. By recognizing and addressing this critical mistake, you can avoid significant losses and ensure your investments are working towards your financial goals. In conclusion, investing errors can be costly, but by being aware of these common pitfalls, you can protect your wealth and achieve long-term financial success. Remember, it's not just about avoiding mistakes, but also about learning from them and improving your investment strategies. Thanks for watching, and I'd love to hear from you in the comments. What's the biggest investing error you've made, and how did you learn from it? Don't forget to check out my other videos for more investing tips and strategies.